In today's video, I'm going to be breaking down if a dividend is safe. So sometimes you'll look at a company and say, wow, that really looks nifty and neat and the greatest. A 7 or a 6% dividend. Wow, I want that. But then you think back and you're saying to yourself, well, okay, that doesn't seem safe. Why are all of these other companies paying a 2 or a 3 or even a 4% dividend, yet this one is paying 6 or 7%. Or how about this? You look at a Canadian bank when they start getting up to 5% dividends, and you say to yourself, is that actually safe? So today I'm going to be really breaking down to see if the dividends are safe in the companies that you may be looking at. So really quickly, let's get down to the paper. Let's say your company is paying a 5% dividend, and you want to see if that 5% dividend is safe. You want to look at the earnings. Earnings are very, very, very important, because if your earnings are, let's say, $100 million as a company, and that's not the amount of money that they brought in, that's the actual revenue, that is the total profit margin. They made $100 million. Is that 5% more than that $100 million? So now you need to go and look at the individual stock and look at their earnings reports and see what their dividend pays out total and how much they actually made profit. Because out of that, let's say their 5% dividend actually costs them $120 million to be able to actually have. That would mean that they are now paying out $20 million more than what they actually earn. However, instead, if they were to actually only pay out, let's say, $60 million, then at that point, that would be good, because now you know that they're going to be able to actually pay that amount, and they will not be able to pay that for very long. Now, there are times where companies will continue their paid dividend. For example, some oil companies during this recent downturn kept their dividend at the same amount in hopes that because they have a lot of cash on hand, they can still pay that dividend until the point where oil starts becoming, of course, more profitable again, which it's now profitable again because oil has gone through the roof because of international concerns with certain countries. So because of that, they're able to pay their dividend still, while other oil companies cut their dividend. See, there's a negative consequence for either one. So if you're a company and you're paying a 5% dividend, and let's say that equals to be 40 cents a share every quarter, and you say, we're not making that much money right now because oil's not doing very well, or whatever the product is that you're currently trying to sell is not doing very well. We need to cut that 40-cent dividend down to 20 cents. Well, what's going to happen to your stock? We've seen this with the Laurentian Bank. We've seen this with many other oil companies and mining companies, and that is the stock decreases a ton because, of course, now investors are going to say, well, why would I invest in this company that's losing money, that's now paying me a 2.5% dividend, versus another company where I could invest and that company is going to be paying me a heck of a lot more and it's more safer. So that would be a negative consequence if a company lowered their dividend. However, another negative consequence of paying too much of a dividend is now going into debt or using up all of your free cash that you have on hand. So you really have to look at, for one, is their dividend outpacing their earnings? If it is, probably not a good time to invest, or it could be a good time to invest if you think that's going to turn around. However, it's really not a good time to invest if they've just potentially lowered their dividend and they may still be exceeding their cash flow, in which case that would also still be a negative because you now know at that point that dividend is going to continue to decrease. So there's a lot of things that do go into respect to the dividend. Now, if you're looking at a company that may be going through some hard times, let's say an oil company when oil went negative $30 a barrel. Now, at that point in time, if the companies kept paying their dividend because they kept on saying, well, we got enough cash on hand to be able to do this. Now, at that point, you can look at their cash. You should be able to find that out quite easily in their releases every quarter as to how much cash they have on hand. And then you can kind of gauge to say, okay, well, if oil's going to be negative or bad for the next 6 months, do they have enough cash to continue to pay this dividend? If not, then maybe a month or two from now that dividend could decrease, and it's probably not a good time to buy. So there's a few things that you can look at to actually see if your dividend is actually safe. And you can actively do this every quarter or every month or whatever you feel like. Personally, I just look at a company and I generally only invest in companies that have a safe dividend. For example, the big 6 Canadian banks. They haven't lowered a dividend in over 100 years. They froze a dividend, as in what they did recently, where they continued to pay the exact same dividend, but they couldn't raise it. But they have never dropped a dividend over the past 100 plus years. So because of that, I feel like those companies are safe. They've made it through multiple different recessions and some really, really bad recessions, and they're still near all-time highs. So because of that, companies like that, you can kind of look at and say, well, they're going to be around for probably ever until Bitcoin or another cryptocurrency basically devalues their company because there's no transaction fees when it comes to Bitcoin as of right now. You wait until the Canadian banks start accepting Bitcoin in their banks, and when that happens, you see really quickly how fast Bitcoin's going to have transaction fees because the banks want to make money. However, we also see in that, of course, there is the fact that the Canadian banks are still looking kind of forward, and they're now charging even more money for their monthly fees when it comes to bank accounts. So I'm going off on a little bit of a tangent right here, but this is basically a video on how you can see if your dividend is safe, whether it's with ETFs that hold specific stocks, or if it's with an individual stock itself, like a bank or an oil company or whatever. I hope that this video has really helped you. If it has, hit that like button and subscribe, and I'll see you guys again next time.